The hunt for yield has increasingly seen investors put their money to work in new types of income-generating exchange-traded funds. But how do these ETFs work and what are the risks? Joining us now to discuss, Andras Rincon, Managing Director and Head of ETF Sales and Strategy with TD Securities. Andras, great to have you back on the program.
Thank you for having me.
So this is a trend you've been noticing, the surge in U.S. derivative-based income ETFs. What are we talking about here? How do we understand them?
Look, it started in Canada many years ago with covered calls, and we've seen obviously the proliferation of covered calls in Canada. Not too long after, the U.S. Started launching covered call ETFs and increasing a lot of those strategies. Now, the largest actively managed equity ETF is a covered call ETF in JEPI from JP Morgan in the US. So now you see a lot of money going into these yield-enhanced strategies. Well, the market is taking another step into the direction of more exotic or strategies or more complicated strategies. Now what they've done is they've integrated what traditionally was a more over-the-counter transaction, which is a structured note. So they basically are trying to get into the structured note business, which is historically, once again, a little bit less liquid, doesn't really trade on an exchange, and they've integrated it into an ETF, and they're selling that to many investors in the US. We do have funds, not in ETF form, but in mutual fund form in Canada that do similar strategies. But in the US, Calamos was the first one to do it in ETF form, and now we're seeing innovators and others do that. Just in the first few months, Calamos did it, that they launched. They have over $300 million in assets under management. The ticker is CAIE in the US. And it's really, really interesting because, as I mentioned to you earlier, these strategies are generally meant for the sophisticated investor, and they're now offered to the entire public. In terms of how it works, and I'm not going to go into all the details.
The covered call ETF was pretty simple, right? So
yeah.
You have this security, you write some calls on it, boosts your income a little bit, it boosts the yield a little. You can sort of understand the risks and reward there. When we start getting the structured notes and all these different constructs, what do we need to be aware of?
Yeah, and I'm not going to get into all the details, but in essence, what they do is they sell calls and then buy put spreads. So what you have is you're getting a certain yield if the market rally, and you're getting some protection or buffer if the market declines. So that's really simplistically what they do. So the benefits are really that you, because of how they're structured and packaged, you get a slightly higher yield than you would get for the exposure that you're getting, for the upside that you're getting. So you do have some upside exposure, even more generally than covered calls. But because of the way they're structured, they're generally yielding 14% plus if the market rallies. Also, on the downside, you do have a buffer. Now, if the market goes below that buffer, the investor tends to be exposed to full downside. And that's where it becomes really tricky, because it's not like a note or a bond. Although these are considered unsubordinated debt to some degree, they are not necessarily in the same world as bonds. They do have a lot of more principal at risk, which is what they call it. So investors need to be wary that, yes, there is some yield to be had, but there's also some downside if the market goes lower. But overall, interesting innovation in the ETF space, and we look forward to see more of these coming into the ETF market.
You talked about maybe for the sophisticated investor, because now you have to start understanding how options work, right? In terms of there's certain ranges where the price does this or the price does that. The outcomes can vary, and they can vary a lot in a big way.
That's right. This is a soup of different derivatives put together to create a certain outcome for the investor. So the investors need to definitely look under the hood of that ETF and understand what they're buying, and really if it's appropriate for them.
Okay, let's talk about something a little bit closer to home. What if an update coming for Canada's regulatory regime? What does it mean for the ETF investor? This is CRM3, right?
That's right. So CRM3, many of your viewers will be aware of CRM3, but if not, in reality, what CRM3 is bringing is more transparency in terms of costs to the industry. So CRM3 is forcing ETF issuers and dealers to disclose more of the total cost of ownership of a specific fund. So what they've now led to is TCR, total cost reporting, and the other big acronym that we're using now is FER, which is fund expense ratio. So the fund expense ratio, which is what everybody will start seeing going forward or next year when it actually comes into implementation, is the management fee the MER plus the TER, which is a trading expense ratio. The MER includes the management fee, which is what most people see. So when you go into the website and say, how expensive is this ETF? Most people look at the management fee. But as I just mentioned, other acronyms, there's a lot more that happens in addition to
trading fees in there now, right?
And there's trading fees, which are mostly for commodity and/or equity ETFs, because there's no commission paid on a bond. It's ingrained in the spread. But you will see now the externalization and the visibility of those trading costs. So, for example, if you have an active manager, they trade in and out of their positions quite more than a passive ETF. So their management of that fund will be more expensive. And you generally would see that there is a difference between the costs overall that you pay in terms of trading expense ratio between a passive and an active ETF. And it's important for people to understand this, and this is why they're doing this. The FER can vary wildly from close to zero, depending on the type of fund, to 7%.
Wow.
And obviously, when you include performance fees, all the legal fees, all the trading commissions and fees, that can add up over time. The median for the ETF industry is closer to 60, so 0.06%. So a fraction of 1% basically. But for some ETFs, like let's say in the liquid alt space or in the leverage space, the number is closer to 2-3% depending on the ETF. So it's important to understand what you're owning. It's not just the management fee, which was what you saw before on the website. Now, CRM3 is mandating that you can show all of these costs separated, which is management fee, MER plus TER which includes or comes out to the fund expense ratio.
A little more clarity for investors coming. Fund flows. Every time you're on the show, I want to talk about where's the money moving. We're seeing very interesting moves in equity markets, in materials, and gold. What's happening with fund flows for ETFs?
So once again, and I sound like a broken record, but breaking record in terms of fund flows in Canada and soon to be in the US. So in the US, we're almost at the same level that we were last year. Obviously, we still have a couple months to go, so it's widely expected to break another record overall. In Canada, we've already surpassed that number by quite a bit, so we're seeing record inflows in Canada in ETF land. That comes, obviously, as I've mentioned before, as people move away from mutual funds and into ETFs, away from stocks and other vehicles into ETFs, so we're seeing a lot more money there. Interestingly, fixed income, seeing a ton of flows and breaking new records both sides of the border. Obviously, the whole ETF industry is seeing inflows, but fixed income continues to grow. Another area that's very interesting is active. Traditionally, everybody thought of ETFs as purely passive or indexed products, but as we've talked about before, in Canada, we're leaders in actively managed ETFs. Call it just shy of a third of ETFs in Canada are actively managed ETFs. In terms of flows, we're seeing over 50% of every dollar that comes into the ETF industry is going to an actively managed ETF. That number is very big. So it's important to keep in mind because it was very close last year. This might be the first year where actively managed strategies see more inflows than passively managed strategies in ETFs. Now, in terms of the US, that number active ETFs used to be 5, now they're only 10% of the market. But flows-wise, they're over 35% of every dollar that comes in is in actively managed ETFs now in the US. And that area will grow very quickly in the US, especially now as they are soon approving the US ETF share class in the US, where we're going to see a lot more US ETFs in actively managed strategies.